FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 2/26/20. Month is almost over. What else can happen? What hasn't happened this month? We got the coronavirus. We got precious metals breaking out. We got the market, well, appears to be, if it's not in correction territory now, then it's certainly very close to it. I've told you my own personal opinion on many occasions. It's going to take a lot more than a virus, a run-of-the-mill, maybe 3 times worse than a flu virus, to stop this market, to stop the money printing. In fact, the coronavirus is probably having the opposite effect. You know that the companies in China are running out of money. They've got between a 30 and 90-day window where they basically shut their doors. So the Chinese central bank is going to go into monetary printing overdrive. And what does that mean for you? How do you profit from it? Well, I think you're already starting to see it in the metals market. It hasn't hit the stocks yet, but no doubt it's going to, almost for certain. This is like the pressure cooker where they keep on increasing the temperature. It's going way beyond the manufacturer's original specifications to the point where it's like 10,000 pounds per inch, and then it's going to blow. And when it blows, that's where the money is made. It's going to happen very quickly. So if you're not properly situated and prepared for it, you're going to miss it. And then you're going to kick yourself yet again. I missed Bitcoin. I missed the Dow when it was 7,000. And now I've missed the mining stocks yet again. But that is the risk. I don't want to promote FOMO, fear of missing out, but that is a real probability here. And got somebody here that you're definitely going to want to hear from on that topic. His name is Brian Leni. The name of his website is Junior Stock Review. And make sure you stay tuned for later in the interview. We'll be giving you a special promo code to get his premium service at a discount. Brian, it's great to have you back on. And interesting times we're living in, isn't it?
It certainly is. Thank you for having me, Gary.
So when we look at what's happened, well, before we talk about the markets, etc., which we will talk about, I promise you, let's talk a little bit about you, because normally people get into what you're doing in a more direct route, but you kind of wound up being a newsletter writer and a individual investor on a different route, didn't you?
Absolutely. Yeah, I'm an engineer by trade. Out of school, I got into the steel manufacturing business, and I was working as a process engineer on the floor and doing CapEx projects, putting in equipment, improving efficiencies and that sort of thing. And then about 4 or 5 years in, which is about halfway through that total career in steel, I got into management, which is, for anybody who's made that transition from technical to management, it's a huge jump, two totally different jobs. And I set forth on that new path. But ever since I started making money, I've been an investor in the market, and in particular around, I guess it would be 2006, 2007, I got interested in gold and, monetary policy and that sort of thing. And I went down the rabbit hole, and it brought me to junior resource stocks. And I was intrigued, of course, by the huge gains that could be had. And from there, over the next, 10, 12 years, I've been an investor. And so in 2013, kind of leading up to where I am today, I made a huge decision, and I sold my house and used 2/3 of the equity to invest in what I thought were the best junior resource stocks over the course of 2014 and 2015. And for those that have followed the market, for the last little while, they'll know that in 2016, at least the first 8 months of the year, we had a huge reversal in sentiment in the market. And from there, my portfolio went up around 300%. And that, along with having a very supportive wife, I left my career in steel to become an investor full time. And then second to that, one of the things that I've always concentrated on is having as good of self-awareness as I can. And one of the things that I've learned over time is that the main part of my learning process is actually through the process of writing. And in that, I started a website, juniorstockreview.com, and I started writing about what I was investing in the sector. And then people started subscribing to my work and were successful in matching the investments that I was making in the market. And now 4 years later, I've moved from a free service to a paid newsletter. And that's where I am today.
Now, going back to 2016, we saw some stellar gains, but they didn't last. That rally had no staying power, like you said, around 8 months, and then it was over. How did you know to get out when you got out? I assume you got out.
I think, you know what, honestly, because it was such a huge transition in my life, I actually lucked out in the timing because, my wife and I and my family, we actually moved. So I live near Toronto, and I lived even closer before. But when we made this transition, we actually moved to about 2 hours east of Toronto to where my wife actually grew up. And in that transition, I took a bunch of money out of my portfolio because we bought a house or rebought a house. And so it forced me to take money out of the market. And honestly, by luck, the timing was right. But it also was a huge learning experience to me. And it's something that I've practiced over the last 4 years is you have to take profits when profits are there because you never know what's going to happen in the market.
And which is often easier said than done. Like, I never made any money in the market. Personally, I'm telling you my own story here until I learned that, I made money in my 401k because the money just kept going in there every month, whether the market was going higher or lower. And over time, caught a big, huge secular bull market, and it just quadrupled, quintupled over time. But doing my own stocks, I never made money until I learned that you had to take a profit. And I've heard Mickey Fulp mention this, but in 2011, the mining stocks, again, were going crazy. And I had returns. I was buying a lot of warrants, returns of like anywhere from 3-4 times to 12 times. And my portfolio had quadrupled in a matter of months. And at that point, I sold half of everything, and still the market continued to go up. And then I needed the money for some reason, and I just sold everything off around, I guess it was October, November of 2011. And that turned out to be the peak. The only time in my life I'd ever done that. I'm not telling this story to show how smart I am, because I was more lucky than smart. But the point is that if the old Wall Street saw, you can never lose money taking a profit, right?
That's right. That's right. And you're right. It is a hard lesson to learn. We typically have to learn through failure. But, a mentor told me, is like, if you can learn from other people's mistakes, then you're way ahead of the game. But unfortunately, and I'm in the same boat where I've had to learn watching, gains, 100% gains go right back to where I started without taking any profit. And, luckily over the last 4 years, that's been a big transition for me is the ability to take profit and not worry about what I've left on the table.
Yeah. So, like you're never going to get in at the bottom and you're never going to get out at the top. Usually, on occasion, it can happen, but that can't be part of your strategy, can it?
No, it's like, I don't know anybody that has that good of timing. And I really think it's almost impossible.
I always say that timing is everything in life. And of course, when I look back at my investing career, the times where I really cleaned up, I was more lucky than smart, if you will.
Sure.
And that definitely, there's something to that. So becoming a newsletter writer, was that a natural evolution from becoming a successful investor, or was it vice versa?
Well, if honestly, I kind of stumbled upon it. It was something where I was basically writing articles on what I was investing in, kind of unconsciously because that's just how my mind works. Like I can make a decision. I especially where I am today, I can sort of, throw out companies that I'm not interested and look at companies I am interested pretty quickly. But to fully understand the investment thesis, I need to write it down. And basically what I'm doing is trying to explain my investment thesis to somebody else. And I think it's really good practice for anybody out there that wants to get better at investing, is try to explain your investment thesis to somebody else. And that's what I was doing through my writing. And it was by chance that I met a few people and they're like, you know what, you should write this stuff and just post it on the internet. You can do it for free over WordPress and, just see where it goes. And that's exactly what I did. Now, in saying that, I think my analytical ability certainly made me stand out from others because I made the right picks and I made the right moves with my money. But, it was kind of by chance that I got into this whole writing thing. And I've been really happy, helping other people make money in this, tough market.
All right. So engineer, all right. You went to engineering school. You're basically science-based. So you look for evidence. How does that work in the stock market where eventually you analyze something to death and then you got to make an intuitive decision? How does your process work?
FSN Radio. It's all about what's next.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
The Financial Survival Network. It's all about what's next.
Well, for me, I'm a company fundamentals guy first. And I've heard this termed as bottom-up approach. So I don't look at the metal. I'm agnostic to what the metal is. It doesn't matter if it's precious metal or base metal. What I'm looking for is opportunity or profit opportunity. And from there, once I find a company that is selling or has a value that is more than the share price that they're selling at, then that's when I dive in further. And then, of course, the interesting part about the junior resource sector is it really is a people business. Without the right people moving a company forward, even the best projects can destroy value for investors. And so that is definitely one of those qualitative forces that, even if you're analytical or even if you have analytical ability, you need to be able to broaden your spectrum and be able to read people and understand what's going to make them successful. So for me, I look first at the fundamental value of the company, and I'm looking for companies that are trading for less than they're worth. Then, they need to be led by the right people. And then they need to have a number of catalysts that are going to move that company or get recognition from the market as to them being undervalued, whether that's through a drill program or, metallurgical improvement, that sort of thing. And then finally, they need the cash to execute on that action plan that's going to form those catalysts. And if they've got all of those in place, then that's what I use as the basis for my investment thesis.
All right. So basically, I guess you use the engineer in you to hone in on those prospects, learn everything you can about them, but then you got to make a decision. Is the decision ever emotional?
Absolutely. And that's that's something that I try to guard against. And I think there is something to be said about some emotional intelligence. And this leads to that kind of qualitative point that I talk about, reading people and understanding who those people are. But in reality, emotions affect us all, no matter how you slice it. Even the best of us, have a hard time removing bias, or essentially you can't move bias. But what I have done over the last, probably 5 years, I invest according to a set number of rules. And I have a piece of paper that actually sits on my desk, and it outlines kind of the rules that I'm anchored in to make an investment. Things like I said, I need to buy value. I need to find a company that is selling for less than it's worth, and then follow that process that I outlined. Another rule would be don't chase a stock. I've done all the analysis and I say, okay, the company is worth this, and I'd like to buy the company at, let's say, 10 cents a share, but it's selling for 12. I want to be patient and see that stock price or share price come back. These things move in waves or in cycles, and it has been my experience that typically you get another chance to buy it at that price that you wanted to, if you missed it by a day or two or something like that. So that's what I use as kind of the basis of my investing. And I would highly suggest that people do it too. Have a list of rules that they want to invest by. And then whenever that emotion, you feel like the need to jump in to buy a stock or do this or do that, you refer back to your list and say, am I following those rules that I set out? And I think if you do, that'll help you contain emotion, because, it's almost impossible to do it otherwise.
All right. So obviously in your newsletter writing and in your travels and becoming a professional investor, if you will, you've come across a lot of people. What is the most common mistake that these individual investors make here, Brian?
Honestly, it's something that we've already touched on, and I think is they don't sell. I think people get so wrapped up in too much of the macro, picking a company that's got 10 bagger potential and then waiting until you get 10 times their money to actually take a profit. I think that's probably the biggest difference in a professional investor and maybe your average Joe. If people can learn to, it's good to pick companies that have 10 bagger potential. You need to have the time horizon for it to reach 10 times your money. Typically, these things don't happen in a year. Typically. So if you have a large time horizon and you're willing to sell some of your shares along the way, I think you can be very successful. But I think those that try to wait out that 5 years or 3 to 5 years and get that full 10 bagger and, don't use the troughs and the crests in the cycle to buy and sell, are going to be very tested emotionally. And to my opinion, it's much easier to learn to sell along the way than it is to wait for that, endpoint to offload.
Yeah. And so look, when people really, they mess up like that, the inclination is kind of to blame other people, right? And to not take responsibility. So you're going to have losses in this situation, this instance, right? How do you deal with it and go on to your next potential victory?
That's a great question. And that's, people tend to take losses harder than they do or the emotional spike is harder on the downside than it is on the upside. And that's something I've read about human behavior, and I've experienced it. The thing is just as you say, is to understand that you are going to get some of these wrong. These junior resource companies are speculations. They're not investment grade companies. So you need to mentally prepare that you're going to take losses somewhere along the way. And Rick Rule has a great saying. He's like, when the story changes, you need to sell. And that's what people need to realize, to think that the company is going to have their story change. Let's say it's they're looking for gold in the Golden Triangle, and all their focus and all their expertise is on the Golden Triangle, and they have a failure there. And then they said, okay, we're going to do a reset, and now we're going to be exploring in Nevada. Well, or maybe even more extreme, we're going to be exploring in Peru. And you really got to think to yourself, well, does the expertise of this management company or does the new story fit? And it typically, I think what you'll find is that when the story changes, very few of these companies can actually turn it around. And I can attest to that because I've unfortunately been the victim. And therefore, when the story changes, you need to sell and you need to find a way to accept it and move on, because that's really all you can do.
Right. But the nature of human beings is you want to believe. And you want to believe that you got a winner here, and it's very difficult to accept that, isn't it?
Absolutely. Absolutely. And it's another thing that I've learned. But when you form your investment thesis and you're going to have, let's say, 4 catalysts, whether it's drill results, metallurgy, whatever, and you write it those questions that need to be answered. And as the news releases come out and you're answering those questions and you're getting a yes, and then finally, maybe the pinnacle of those drill results in metallurgy is an economic study, a PEA or PFS or FS. And the FS or this economic study comes out and the economics just aren't there. That is a clear sign that that project is most likely dead, and it'll either need a much higher metal price, or it's going to need a company or a new management team probably to come in and completely rethink the project. And those answering of those questions need to be the catalyst for you to buy or sell, right? And so if those questions come out all good, then maybe it's a buy going forward. And if they aren't, they're a sell. And if you can be more agnostic to the percentage loss that you're going to have, I think you'd be much more successful.
Okay, and so. Risky business. Should you be, when you're investing, should you be investing in expectation of a higher metal price, or invest in a project that is viable or feasible at the current prices?
Then that's, for me, I've learned in the last decade or so that I'm not any good at predicting where the metal price is going. And I would suffice to say, I would say that nobody is really that great at predicting where a metal price is headed. These are complex markets that are across the globe. And really, I think it's a fool's errand to try to say this is where the zinc price is going or this. And even if you do want to predict it, take it with a grain of salt. And that's why I focus on the company fundamentals. So I don't believe you pick the metal first. I think you look at the company's fundamentals, and like I said, you have that certain criteria that feeds into what the fundamentals of the company are. And as long as the company is selling for less than they're worth, then you've got your downside protected. And then you go from there. And I think if investors take that approach, I think they'll be much more successful with any of their investments in the junior resource sector.
Right. So you have to be metal price almost agnostic. But if prices are going down, at some point your investment, the company is not going to be feasible. It's not going to. It's just not going to work.
Absolutely. You know what? And that the other side to that is that's why I always try to stick to the top tier deposits. So even if that share or if that metal price does go down, then at least that you're invested in the best of those undeveloped assets. And whenever that market does turn, you are most likely going to be that first deposit or company that is bought or developed into the next mine. Sticking or trying to buy mediocrity and thinking that it's going to become something, I think you're fooling yourself. You need to stick to those tier 1 deposits, and this mostly revolves around economics. You want to get in that first quartile cash cost. And those are the projects have the best chance of actually becoming mines in the future. And those ones that are stuck in the mediocrity, maybe there's a good trade in there. Maybe if you get some good strength in the metal price, maybe there's a nice trade to be had. But if you're going to hold an investment for over a long term, I think you want to stick to the best of the best.
And so, and then eventually you're going to see disappointment in any of the stocks, no matter how good they are. And like you said, one time to sell is when the story changes, but there's other reasons to sell as well, isn't there?
Oh, absolutely. Absolutely. And they can be a myriad of things. And actually, I think, when it all comes down to it, there's very few positions that you're going to want to hold over the long term because there just isn't that much quality out there, in my opinion. And it can be a number of things that can be or signal a sell. And for me, in my portfolio, I usually carry at a maximum of 15 companies. And out of that 15 companies, I think there's probably 2 or 3 that I've held for more than a year now. The other ones have kind of reached a point where I think that I take my profits and go to the next one, or I don't see a good future in them, so I sell.
Yeah, and obviously, that's one of the keys: discipline. When you're looking at a stock to buy, all right, you have a checklist like most people. a screen, if you will. How tight is your screen?
It's pretty tight, especially in the bear market. I want to be, like I said, I want to focus on the best of the best and, not really worry about any of the mediocre companies, because you're really setting yourself up for a huge amount of risk. So I use that set of rules that I mentioned, and it is pretty tight. But I am agnostic to the metal, so there is lots of choice out there. I'm constantly, like with PDAC coming up at the end of this week, I'm really looking forward to it. Like I've got 30 meetings in 4 days, and it's on a wide spectrum of metals. And I'm really looking forward to seeing what's there. And I will use that list to pick through and stick to those best investments, or the ones that give me the best downside risk for putting my money into the market and potentially making money from them.
Right. So we look at the price of gold right now as we're speaking. It's right around $1,650. It's gone up $75+ last 30 days. 1 year return, $321 an ounce, over 24%. And yet the stocks, the mining stocks, have not followed suit. At least the smaller ones, the juniors, have been stuck in this trough. What is it that's holding them back?
That's a great question. Honestly, I don't know. It's really surprising to a certain extent to see the strength in the metal price, but to still see a lot of red on my watch list. Like my watch list is probably around 300 companies. And like just for instance, this morning, all I see is basically red. There's a few nice greens on there, but you know what? I think it's indicative of fear in the market. And I think in one side of the coin, it's smart that the fear trade is leading to a higher gold price, because I think that the gold price, given everything that's going on in the world, is vindicated. Like it makes sense. And, if you don't have a good outlook on the junior resource companies, which is totally separate from the metal, then it makes sense to sell. But at this point, we haven't seen a huge recovery, so people are selling to get out. So I really do think that means that it's fear across the board, and people want to be in cash or some sort of safe haven thing to see what's going to happen, because coronavirus looks like it's maybe blown out of proportion. I really don't know, but there's definitely fear.
Yeah, fear. Warren Buffett, when there's blood in the streets, that's the time to invest. And you can't invest in these stocks in a vacuum. When you see the way the broader markets, the broader averages, the Dow, the S&P 500, the NASDAQ, the Russell 2000, the way they have gone up over the past several years, and really over the past 10 years, and then you look at the returns in the mining sector, do you ever think maybe I'm in the wrong line of business?
FSN Radio. It's all about what's next.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
The Financial Survival Network. It's all about what's next.
Sure. I definitely, well, you know what, especially when we're into that bear market and you're seeing that people are making lots of money in blue chip type of investments, sometimes you do have that, maybe it's FOMO or am I doing the right thing? For me personally, though, I've over the last 4 years, I've really refined my process, and I've made money through the bear market and, been able to support my family and make or put savings away. So I feel pretty good about where I am in terms of my process. But broadly speaking, for people that have been focused on the resources, are probably thinking to themselves, my God, when is this market going to return? Especially when you see the broader market seemingly going up forever. But I think that also signals that we could be in for a reset at any moment. We've been 10 years or more than 10 years, 12 years without a real big correction in the broader market. And, could you be just around the corner?
Yeah. And, I've been in this sector. I became a full-time podcaster, and my business model was I was going to get sponsored by mining companies. I wasn't that much in it for the money. I just loved podcasting and communicating and all that. But my date, I started June 7th, 2011, full-time, and the gold hit its peak in October, and it's kind of been all downhill since then. And I've watched these experts, and they keep saying, well, we're almost there. And basically nobody knows what the hell they're talking about. From a very few people do. That's the God's honest truth here. And you listen to FSN, then you've probably heard several of them. The cycle guys have gotten it right. The fundamental people have been wrong consistently and have doubled down and tripled down to the point where a lot of them are gone from the space. A lot of the newsletters have shut down, and a lot of just a lot less people, a lot less players, a lot less investors who are tired of getting burned over and over and over again. And to those people, what do you say to them, Brian? I mean, what do you say to the people who've really seen the broader market skyrocket and their portfolio, their mining stock portfolio really take a hit?
Well, I think all I can say is that, first and foremost, you need to understand who you are and what you're looking for. If you're looking for safe haven investment type things, maybe the broader market is a better place for your money. You need to realize what your risk tolerance is. Obviously, if you're focused on junior resource sector investing, you have to be comfortable with volatility, and you have to be comfortable with the bear market side of things, as it's a very real part of being an investor. So, I think most of the time what happens is people have misinterpreted what they want and what they're able to handle in terms of where their money is. And because of that, they take times like this really much harder than they probably actually should. And in saying that, if you have a good handle on who you are, what you want out of your investments or speculations, then you need to be comfortable with where we are currently in resources. Second to that, if you've decided that, okay, you know what, I can take the risk, and I'm not using the mortgage payment to take that risk, but I want speculative upside in my investments, then I need to spend some time and learn how to decipher what is a good investment and what isn't. And that criteria, there's some baseline stuff that you can come up with yourself, and then there's some stuff that you can improve on and learn. You can learn a little bit more about metallurgy, you can learn a little bit more about geology, all those different components that feed into being able to analyze a stock. And then the other side to that is, you can use guys like me, newsletter writers that you trust, that are looking for those best investments, and you can take some advice from them, and that supplements what you're already doing with your money. But I think first and foremost, as a resource sector investor, you need to understand that there's risk and there's volatility, and that there is both a bear and a bull part of the cycle. And accepting those things, will go a long way into being able to ride the emotional roller coaster that is of junior resource sector investing.
Hey, and I couldn't agree with you more. I think you made some really good points there. You got to know thyself, and then to thine own self be true. You got to be who you are. So speaking of that, obviously your career path was a little risky. Engineers, basically you find your place and you're kind of set for life there often, or, the job market, shortage of engineers in many sectors. So for you to kind of do this, you had a wife, young family, support from your wife. Did she think you were insane at first, or where was she in all this?
Yeah, that's a great question. You know what? I've been extremely lucky that my wife has a lot of faith in me, and she's been basically unconditionally supportive in believing that the financial decisions that I was making were right for our family. And I think the other side to it is I think the downside risk for me in particular was lower than some people, as I made some money in the market to begin with before I left my career. So we had something to fall back on. My education and my experience in the market, I could have gone back to the steel manufacturing business in the blink of an eye, and I still could now if I really wanted to. So really, while it was a major change, I think that the downside risk in our family making that change really wasn't as crazy as it might be in other cases for people. But the bottom line is I couldn't have made that change. I have 3 kids too. I couldn't have made that change without her support. And it has made all the difference in our lives.
Hey, and now you don't have a 9-to-5 job or 8-to-4 or whatever. You're there for your kids whenever they need you. So that's got to be a great feeling to have that freedom to watch your children grow up and be at all of their stuff and really be a part of their lives when a lot of us out there wind up really working our way through our kids' childhoods and often missing some of the best parts.
I'm extremely lucky, and I'm very grateful for what I have now in my life. The side note to that is my wife and I have decided, because of a number of reasons, we also homeschool our girls, and being a part of that process and allowing them to focus on, things that they're interested in has been an amazing ride. And they're still very young. So I'm really looking forward to how they develop and, following them along that path and watching them, because, it's been amazing so far. And again, I'm extremely lucky to be in the position that I am.
You certainly are. Hey, just tell us, you got a special offer for any of you out there listening to the show. How does that work, Brian?
Sure. It's my pleasure to offer your listeners 40% off my subscription. So the promo code is Kerry, Kerry. You input that on the shopping cart and you'll get 40% off that price. All prices that you see on the website are all in Canadian. For those US
really good deal
viewers, I think it's a very good investment proposition, and I hope to see you guys as subscribers, and contact me anytime.
All right. Hey, and you got 2 weeks to get that done. It's not forever. So you got to act.
That's right.
Act now for a limited time. Remember, my name is Kerry, Kerry. It's not Carrie or Cary. It's Kerry. So get that right. Otherwise, you're not going to get your discount. And look at it this way. With the loonie being so depressed against the dollar, it's trading for a little more dollar, with a US dollar, you can purchase a Canadian dollar for a little bit more than 75 cents. So you're effectively getting a more than 50% discount when you factor in the currency. If you're in Canada, well, too bad. You're only going to get 40% off, but you'll have to be satisfied with that. Hey, Brian, really appreciate you coming on. Questions or comments, and what do you think about Brian's strategy, philosophy of resource company investing? It's such a risky sector. One thing we didn't talk about, Brian, is it's an essential sector. Life as we know it relies upon a plentiful supply of these metals and elements. Maybe not necessarily gold, not so essential, but certainly silver, platinum, palladium, lithium, lead, zinc, copper. Copper is essential, and so many others. I don't have the periodic table of elements in front of me, but so much of what we mine for is on that list. We can't have life as we know it. I mean, even something like rhodium, nobody even knows what rhodium is, Brian, but rhodium is an essential element in catalytic converters and in bulb fountain pens, which nobody uses anymore except me, if and when I do write, which hardens it and makes the catalyst go much longer and last longer. Right now, rhodium is $11,000 asked, and nobody even knows what the stuff is. There's very few places that produce it. I'm digressing, but the point is that life as we know it relies upon this sector, and this sector is beat up, but eventually this sector will be embraced again by the market, by the general public, when there are shortages of key metals and minerals, and we realize how much we really do need them. In any event, appreciate you coming on. Questions, comments, KL@KerryLutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network, and of course the home website, financialsurvivalnetwork.com. Brian, good luck on your investing. Great luck on the newsletter. Hope your circulation continues to expand, and we will talk to you again.
Thanks for having me, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.